Welcome to Crypto Plus, where we bring you the latest information on cryptos, blockchains, definance, and futuristic investment vehicles. Today is Tuesday, the 20th of July 2021, and we can see that cryptos are continuing their fall after yesterday's mini crash. And we're of the opinion that previous all-time highs in general will not be reached again by the majority of cryptos until the markets have been fully routed and the regulators have decided what they are going to do about stablecoins. Let's explain why we say this and take a look. Financial Times article dated 20th of July. Headline: Cryptocurrency markets slide as Yellen leads mounting regulatory scrutiny. This was literally published just a few hours ago and may highlight one of the additional reasons why we're seeing such a fall in cryptocurrencies. Cryptocurrency markets have come under renewed pressure after top US officials, including Treasury Secretary Janet Yellen, said they expect to issue recommendations on stablecoins, important assets in the digital economy, in the coming months. Bitcoin has slipped about $2,000 over the past 2 days to about $29,500, leaving the most actively traded coin flirting with lows it reached late last month. Other major coins such as Ether and Binance have also come under selling pressure. The crypto retreat comes as global financial watchdogs have been clamping down on the sector after years of almost unrestrained growth. And certainly there's no doubt that its rise a few months ago to all-time highs, many tens of thousands of percent above the original cryptocurrency issuance value, has certainly attracted the attention of regulators. Yellen underscored the need to act quickly to ensure there's an appropriate US regulatory framework in place. At a President's Working Group on Financial Markets, she convened on Monday to discuss the tokens according to details released from the meeting. Participants discussed the rapid growth of stablecoins and their potential use as a means of payment, as well as potential risks to consumers, the financial system, and national security, the Treasury said. Now note that. Financial system, consumers, national security. Attendees of the meeting included the heads of the Federal Reserve, the Security and Exchange Commission, the Commodity Futures Trading Commission, and the Treasury, as well as the Office of the Comptroller of the Currency and the Federal Deposit Insurance Corporation. Buying cryptocurrencies such as Bitcoin or Dogecoin directly with standard currencies like dollars or sterling can be a cumbersome process. Stablecoins aim to make it easier. They're privately issued digital tokens pegged to other assets, and many claim to be backed one-to-one with dollars. Tether is the biggest, and half of all Bitcoin trades are transacted using it, according to Crypto Compare. Now that's important, because if something happens to Tether, you can imagine what effect that will have on Bitcoin trades. Its closest competitor, USD Coin, has grown more than 3,400% since January, according to operator payments technology company Circle, which announced plans to list on the New York Stock Exchange this month. But the gathering of top US watchdogs this week reflects rising concern among governments and central banks about potential risks ranging from stablecoins' potential use in money laundering to their impact on monetary policy. Now let's be blunt about this. Certainly in the early stages, cryptocurrencies, particularly Bitcoin because it was the first, was to a large degree used by money launderers. But we suspect the money laundering, though a concern, is not the major concern because far more money is laundered by the US dollar cash than is carried out via cryptocurrencies. The concern is the impact on monetary policy. The vast reserves that stablecoin operators need to maintain to honour their pledge of one-to-one backing also poses potential risks, and we as previous bankers would agree with that. Tether's reported holdings of short-term debt known as commercial paper make it one of the largest holders in the world, and this is the effect on what could happen in the financial system. Rating agency Fitch has warned that any rapid liquidations of such substantial reserves could destabilize the short-term debt markets. Last month, Eric Rosengren, president of the Boston Fed, named Tether as a possible challenge to financial stability. Earlier in July, Fed Chair Jay Powell told the Senate Banking Committee that stablecoins were growing incredibly fast but lacked sufficient regulation. Late last year, a group of US members of Congress proposed legislation that would require stablecoin issuers to obtain a banking charter, following banking regulations, and receive approval from the Federal Reserve and FDIC. Bank of England Governor Andrew Bailey said in June that stablecoins should face difficult and pertinent questions. The Bank of England warned that operators should not enjoy regulatory arbitrage through looser rules than traditional banks. In other words, the main banking system has to follow certain rules. The decentralized systems do not, and therefore have a competitive advantage. This is about industry protection as well to a large degree. International bodies have also called for more action on this corner of the cryptocurrency market. Last month, the Basel Committee on Banking Supervision, the world's most powerful banking standard setters, said stablecoins would qualify for existing rules if they were fully reserved at all times. And of course, at the moment, the suggestion is that Tether, the main one, is not fully reserved. A paper released this month by Yale professor Gary Gorton and Fed attorney Jeffrey Sang explored similarities to historical examples of private money, which were often subject to runs. If policymakers, and this is important, wait a decade, stablecoin issuers will become the money market funds of the 21st century. Too big to fail. And the government will have to step in with a rescue package whenever there's a financial panic, they wrote. So we can see there is going to be no let-up on regulatory insistence. And it's going to happen soon. And we've seen the fallback now in cryptocurrency markets. For those who think, well, they're going to bounce back and pretty quickly, we suspect, until we know the outcome of this meeting and of what Janet Yellen and company propose, why should they jump back? If you were a major investor, would you really, particularly if you're representing some form of pension fund or investment fund, would you be willing to take a risk and invest in something that might totally collapse depending on the level of regulation? The answer would be no. You would be fired from that organization. And if it's your own hedge fund, you will have people pulling their funds out at a pace. This is why we're of the opinion that the highs reached earlier this year are just that, the highs. And that until a regulated system is sorted, we're unlikely to see those highs again. And we fully accept the fact that we will be in a minority of opinion on this. And we could be proven wrong next week. But we only have to really look at what is going on. Do you really think that a banking industry that has been around for centuries is going to allow some upstart, decentralized, inverted commas as they see it, Mickey Mouse currency providers ruin that institution? We suspect not. And I also suspect that we have not seen the full wrath of the regulatory powers that governments and central banks actually possess. What does this mean in the end? The answer? Compliance. Compliance with regulation, or be routed out into the annals of the black market, which will then expose you to criminal activity as far as the governments are concerned. And no major financial institution, pension fund, hedge fund, or private investment houses will be interested in investing in those. You've heard it here first. We think the peaks have already been in, and until this happens, we're not going to see another one. That doesn't mean the cryptocurrency market is dead. That doesn't mean markets with blockchain such as Ethereum that can run smart contracts are dead. We're not saying that. What we're saying is do not expect the much vaunted rise of cryptocurrencies that so many on YouTube are saying are going to happen in the next month or the next 2 months or the next 3 months. Until we find out what the central banks are going to do, what the regulatory authorities and treasuries are going to do. Because rest assured, if they force regulation on the stable coins, that's going to have an enormous effect on the rest of the market. And perhaps then, if you're willing to speculate, that would be the time to buy. Thank you so much for listening. Please share your thoughts, whether you agree or disagree with us. But either way, please give us a thumbs up, subscribe, and press the bell sign. Until next time. Disclaimer. Under no circumstances what we cover in these videos should be deemed as investment advice, nor an invitation to invest in any of the vehicles or products we mention. We're not authorized practicing financial advisors, and you should please be minded of that. Before you consider any investment whatsoever in any field, we recommend that you speak to a regulated professional financial advisor. Thank you. Have a great day.